Welcome, welcome. Nice to have you here. Let's go ahead and get started, folks. My name is Rick Roller, and I'll be your game show host tonight as we talk about some really fun stuff that's going to help you on the real estate exam. With us today is our executive producer and school owner, Dan, who is going to also chime in from time to time, especially if you guys have questions. Please feel free to ask questions at any time that you want. What we're going to do is we're going to go through a series of questions, surprisingly similar to something you might see someday, or at least the concepts are pretty much the same. And then we're going to answer those questions and give you a little bit more in-depth information about them. Okay. And tonight's topic is settlement and settlement loans and financing and whatnot. And so let's just jump right in. Okay. All right. Our first question tonight is about loan to value ratio. When buyers are going to go up and buy a home, many of them pay cash, but most of them do not. And so what happens is, for those that are not paying cash, they go out and they get a loan. So part of our job is to make sure that everything goes well with the loan, and that the lender and the underwriters and the appraisers have easy access, and they come up with the information that they need in order to do their professional jobs. We're like a conductor of the symphony. And there's all these different players. There's title people, inspection people. Sometimes there's repair people, and there's lenders involved, and all these different people. And you're the only one in this whole transaction that sees the whole transaction, and every bit of its responsibility falls on your shoulders. So knowing a lot about finance is really a good thing, and getting a great lender as a lender partner is even probably more important, because they're the ones that are going to be on the front line making sure that buyer gets their loan. Okay, so if the loan to value ratio is too high, that means loan to value ratio, meaning the more you put down, the lower the loan to value ratio is. The lender will want mortgage insurance to protect its interest in case of default and foreclosure sale. In most all cases, what is the number that triggers mortgage insurance being paid? Now, mortgage insurance doesn't cover your home if you were lost in a fire or anything like that. Mortgage insurance ensures to the lender that if they enter into a situation where they have to foreclose on the home, they won't lose more than some predetermined amount. And the mortgage insurance is not cheap. What happens is that's an additional payment you have to make every month if you put down a low down payment, which makes a higher loan to value ratio. So would you have to pay mortgage insurance on a 95% loan? What do you think, guys? Here's a hint. Yeah. Okay. How about a 90% loan? Yeah. Mortgage insurance required. How about a 75% loan? Mm-mm. And what about an 81% loan? Yeah, probably. Now, here's the deal. Okay. That triggers a mortgage insurance. That's the lowest number that would trigger a mortgage insurance. And the 80% loan, lenders wouldn't require mortgage insurance. So with a 20% down payment, that would require an 80% loan to value ratio. And as long as you put 80% down, or maybe 75% down or more, half down, you don't need mortgage insurance. But anything over 80% will trigger the necessity for mortgage insurance. Okay, that's a good thing to know. Okay. Of course, in this market, it's really that's crazy. Buyers are paying over list price, and they're paying over appraisal price. So if you had a home that appraised for $500,000 and they wanted to avoid mortgage insurance, what would the minimum down payment be? Who wants to jump in and tell me? $500,000 home, 20% down payment would be how much?
100,000?
That's correct. You win a prize. I don't know what it is, but you're going to get a prize. Okay, so that would be a $100,000 down payment. However, what if the purchase price of the home, regardless of the appraisal, what if the purchase price of the home was $600,000 and it only appraised for $500,000? In other words, people today are paying over the appraised value. Then what's the lender going to say? Well, that's tough noogies. If you want to avoid mortgage insurance, still have to put $100,000 down. Plus, you're going to have to pay whatever you and the seller agreed over the top. So they'd have to put 200 grand out of pocket in order to buy that house. Buyers are paying 30, 40, 50, 100 grand more in some cases in the marketplace today over the appraised value, which won't affect the loan to value ratio as far as the lender's concerned. They don't care how much you pay over the appraisal. That's up to you. You got to come out of pocket with it. But loan to value ratio is the down payment, okay, minus the purchase price, and then you have to put the rest of the money down out of pocket. So 80% is the thing there. Next question, please. Okay. In order to obtain underwriting approval for a FNMA federal loan with a loan to value ratio of 90%, what must an applicant have? Primary mortgage insurance, business interruption insurance, flood insurance, homeowners insurance. What do you think, guys? What do you think? Come on. We just talked about it in Infinite Adam. It's primary mortgage insurance. Once again, why? Because he's putting down less than what? 20%. So here's the same concept, but tested in a different way. You still have to avoid primary mortgage insurance. There's FHA have their own pet name for this, but anything less than a 20% down payment is going to require mortgage insurance. Okay. Same concept, little different approach to the question. Okay, let's look at the next one, please. Which of the following is a trigger term as stated in Truth in Lending pamphlet given to potential borrowers? When you're out talking to lenders, ask them for a pamphlet that they have to give to all buyers, and it talks about mortgage terms and whatnot. You ought to get one of those and read it. Not necessarily before the test, but before you get out there active in the business, because you need to know a little bit more about loans. So what is a trigger term? And this is a very important concept for the test. The federal law says if you say any of these things, you have to say all of these things. So here's a list of things: a payment amount, monthly payment perhaps, annual percentage rate, loan, or the price. Now, some of these things are trigger terms, and that would say, if you're going to say that, then you have to say the other things. Okay. Now, would price be a trigger term? I mean, that's really doesn't have anything to do with the loan, does it? No. And what about C, loan? Well, no, that has nothing. Well, yeah, but just the term loan, I don't know. That's not a trigger term. Payment is the correct answer. The only thing, and now another twist on this is, what is the one thing you could say on this list that it is not a trigger term? Well, price is not, loan is not, but APR. Now, things that have to do with the actual financing that they're getting, APR, annual percentage rate, is the only thing you can quote without triggering saying everything. Now we're talking about, the interest rate. What if the interest rate was 2.5%? Is that the same thing as APR? No. APR takes into consideration not only the interest rate, but other upfront costs. Some of the other upfront costs can be factored in. So if your interest rate was 2.5, your APR will always be the same or higher than the 2.5. If you had no other additional cost, upfront cost to get the loan, it'd be 2.5. But if there's, if they're factoring in discount points, if you're factoring in some of the cost to put the loan together, then that would push that to maybe 2.65 or something, or 2.6. APR's main purpose is it's a shopping rate, because a lender can quote a low rate and say, oh man, get your loan from me. I only charge 2.25%. But he has all these upfront costs. Well, you look at his APR, it may be 2.65 or 2.72 or something like that, and this other lender has an APR of 2.5. Well, the 2% loan's better. No, because there's a lot of upfront costs for that loan. So sometimes lenders will disguise their profitability on a loan by charging a lot of upfront cost. And APR is something that the government developed that helps buyers go out and shop for rates by having a standard. If you're going to have a lot of upfront costs, you got to include it in the APR. If there's not a lot of upfront costs, then it's always the same as the interest rate or greater than. Okay, annual percentage rate. It was created by the Truth in Lending federal statute. Okay, good things to know for the test. All of those items. Okay. But if you quote a payment, now you have to quote all the terms, like the duration of the loan and is there going to be prepayment penalty and all these other things. Okay, and that's the difference on that. Next question. Here we go. Which of the following entities is only in the secondary mortgage market and not in both primary and secondary? Okay, which one of these? Okay, now banks, insurance companies, private individuals. And Ginnie Mae, the Government National Mortgage Association. Ginnie Mae on your test is not in both primary and secondary money markets. They're in the secondary. And what that means is primary lenders is someone you go and actually apply for the loan with. You fill out the application with. You think they're the lender, and they are. But as soon as that loan closes, they're going to sell it to somebody else. So a lot of times they're lending brokers or they're primary lenders, and then they package up a number of loans and then sell them to people like Ginnie Mae or Freddie Mac or other types of investors. Banks do both. Banks will actually originate loans, and sometimes they will put them in packages and then have other investors come in with them and whatnot. Insurance companies get lots of premiums. People send in their premiums every month, and some of them die, but most of them don't. And so they have a lot of cash that's coming in. They love real estate loans. So you get an insurance company like Security National Insurance here in Salt Lake City. Security National Insurance is many times in Utah history. I don't know where they stack up right now, but many times in Utah history has been the largest lender in the state of Utah. And they're kind of an interesting insurance company. They do kind of, I classify it as oddball insurance, like, divers insurance and, all kinds of, a lot of burial insurance and other types of special lines. And they do have some life insurance as well. But they're a regional insurance company. They have a lot of money coming in every month, and they love to do mortgage loans. And many of them they keep. And they also do smaller commercial loans, like maybe under 30 million. And so, a lot of 6, 7, 8 million. And, if you want to borrow $8 million for an office building or a medical center or something, medical office building, where do you go? You can go try your bank, but they're not, that's not their business. They like, shorter loans, not 30-year loans. And they like, smaller amounts, that kind of spreads their risk. But insurance companies love those 6, 7, 8 million, 10, $15 million loans. That's where you get them primarily. And of course, the private sector, private lenders, they do it all. They do, hard money loans where they're the primary lender, and then they might join in with others and buy that loan and, share the risk and whatnot. So the only one that's not in both markets is Ginnie Mae. Ginnie Mae is only secondary money market. Secondary money markets where the primary lenders sell their loans to. And the difference between a mortgage broker and a mortgage lender is a mortgage lender actually closes the loan with their own money, and then they sell it on the secondary market to someone like Ginnie Mae or Freddie Mac or Fannie Mae or others. But a mortgage broker often does not use their own money. They make a deal with the secondaries who really take the loan over. Mortgage brokers might also put together loans for the insurance companies on smaller commercial deals as well. Okay, the wonderful world of finance. Okay, and it's going to be okay. You don't have to know everything about everything in order to do something. And when you're working with buyers, you just have to have a good lender. because they know everything about lending, and so you take them in there and you want them to do the job and you want to do it on time and you want them to work hard to make it happen. And you want them to have a really good idea on whether this loan is really going to work or not. So it's great to have a good lender. If you don't have a good lender, keep shopping until you find one. But how do you find a good lender? Well, go to your office and ask some of the agents that are more successful or doing a lot of transactions, who do they like to use for their mortgage lender? And then you might talk to them. And then too, it depends a lot on what type of real estate you're going to do. If you're going to be we're doing a lot of first time buyers, 285, 350, whatever it might be in that market, or you're going to be doing middle or high end. Some lenders don't like to do first time buyers. They just don't like it, and others don't like to do FHA or VA. But if you live up by Hill Air Force Base, you'll probably do a lot of VA. And we have a lot of veterans in Utah, and it's a few years ago, the Veterans Administration and the federal government decided to extend the VA benefits to a larger pool. It used to be you had to be full-time military, but now if you're in the National Guard and you get called up for a period of time, then you have full VA benefits. You can get a VA loan, and then FHA, very small down payments, lower credit scores. If you're working those low end or mid to low end type loans, it's a good way to go. And FHA has loan limits, and recently they've been raising those low limits as the market goes up in value. And for a lot of people, that's a great way to go. Okay. Next question, please. Okay, here we go. All right, we're talking about a VA loan, and a VA loan, the VA lends money and the lender guarantees it. B, the lender provides the money and the VA insures it. The lender provides the money and the VA guarantees it. That one's warm and fuzzy. Hang on to that one. And D, the VA provides the money wholesale to the lender and the lender makes the loan. Okay. VA guarantees the loans. They guarantee the lender that they're not going to lose money, based on a very high ratio of the amount of money that they lend. They might lose a little, but mainly what happens if a house goes into foreclosure and there's a VA loan on it, the lender will foreclose and immediately wrap up the package and send it to the VA, and the VA will give them all the money that they lent. That's pretty much how it works. And so they package it up in the VA because the VA guaranteed it. Now, FHA doesn't guarantee. That's answer C. The FHA doesn't guarantee. FHA insures, and that's B. See, what the devious examinators are doing here is they want to confuse you. Well, I don't know. One of them insures and one of them guarantees. FHA insures and VA guarantees. And veterans, they can get a whole 100% loan if they want it. Okay. Or they can put down some money if they want to as well. FHA requires smaller down payment, 3-5%, depending on what type of loan they're getting and what market they're in and whatnot. But the lender provides the money and the VA guarantees the loan. So, very general thing, but it might be that one question that gets you through the test. Okay, just talked to one of our students Monday, who is not with us tonight because she passed her exam on Monday. And she actually took me up on an offer that I make to all you guys. I mean, if you want to call me at any time and talk about questions, I'm happy to help you. If you're confused on something, pick up the phone and call me. And we'll spend a quality few minutes on the phone and you'll get it. It's just that simple. Well, she was struggling and she was concerned and she wanted to pass that exam, and I totally understand. So I actually met her at a local office here in town and worked with her for about 3-4 hours and got her all tuned up for the test. And I'm proud to report that because of the fine work that Dan does at our school, okay, with his review materials, particularly the key concept review that every one of you should download. Every one of you should get that key points review. It goes through national and state. And these reviews that she joined us on a number of these, she says there wasn't one thing on that exam that she didn't, hadn't been introduced to or didn't have a good feeling about. And of course, she passed. And for those of you that are overachievers, you're going to be upset when I tell you that they don't tell you your score. I mean, what? So I want to know, did I get a 98 or 100%? They don't tell you. It doesn't matter. It doesn't matter. Okay. Oh, hey, that's how you get it right there at that Dropbox link that Dan just put on the screen. We'll leave that up for a minute so you can have that. Okay, let's go to E, Mr. E. Mr. E is going to go out and borrow some money from a bank for personal reasons. It has a fixed rate for a 5-year term. And monthly payments for IO, they're interest only. And at the end, E owed the lender the full amount of the money borrowed. What kind of loan is this? Now, different loans have different definitions. This is a C, a straight loan, okay? A straight loan is where you pay IO, interest only, for the term of the loan, and then you repay all the money that you borrowed. What is the purpose of a straight loan? The answer is C. That's the correct answer. What is the purpose of a straight loan? The purpose of a straight loan is to minimize your outflow on a payment to the absolute lowest minimum, that would be acceptable to you and the lender. Now, there are some other kinds of loans that could even lower it a little less, but this particular borrower didn't want to get in a situation where the loan balance was actually increasing. So if you're paying less than even what the interest is due on a loan, well, they're not going to forgive that money. They're going to add it to the loan. There's some loans like that. Sometimes they call it a walking backwards mortgage because you're not paying it off. It's actually rising because the payment you're paying is less. And there's some loans that do that for a period of time, like for the first little bit, and then they switch over and then they start fully amortizing. It's a partially amortized loan, and that's the definition I was getting at for D, which is not the answer here. But a partially amortized loan is a loan that the payments you're making won't even retire the loan. The loan balance actually goes up because it's a lower interest rate, or your payment is based on a lower interest rate than what the actual rate is on the mortgage. They're great in markets like California, where you can't find anything for under $2 million, and you're trying to take your income and your spouse's income and your son that's going to live with you income, and you're trying to get into this home, and they're do you have one of those loans where the value actually goes up? The principal amount actually goes up because they don't care, because they figure the price is going to go up anyway. In our market, we might see some of those coming out because our prices are getting a little hairy. That's partially amortized loan. Hey, I'm not saying that's a negative thing. I mean, your commissions are bigger. I was telling Dan before we started the broadcast tonight that I was talking to one of my friends that has a property for sale up in the Harvard Yale area, and I wanted to go preview it. And I called her and said, yeah, okay, I got some time. Can I go up and preview your home? No, Rick, it's occupied and we don't want to bother the people. And besides, this weekend I got 14 offers on it. 14 offers on this. You put it on the market, just before the weekend, got 14 offers on it. Okay. Now, the kicker is the home is $1.5 million. Do you realize there's over a dozen buyers looking in the downtown area that have $1.5 million plus to spend on a home? That's pretty exciting, folks. This is an exciting time to be in the business, particularly if you're a listing agent. A participation loan, we're not going to see those in residential real estate. I'm talking about B now. A participation loan is a loan where the bank says, not only do we want an interest rate, but we want a piece of the action. So normally we charge 5%, mostly on commercial. Okay, you're not going to see it on home, but mostly on commercial. So they say, all right, I'll lend you that $6 million and we'll do it at 4.5%, which is less than our normal 6%. But we also want 10% of the equity when the property is either refinanced or sold. So they want a piece of the rock. Participation loan. Obviously, the correct answer to the lender is no, I don't want that kind of loan. I'm taking all the risk. All you're doing is lending me the money. Yeah, but that's a risk too, because we don't know if you're going to pay it back. Yeah, the property is good. It has good rents. It's, whatever. Okay. Okay, well, at least that's what they said. And then, of course, we had COVID and all the hotels are suffering. But anyway, a purchase money mortgage is any loan, or a purchase money loan is any loan where the money is used to buy the property. It's not a refinance, or where you're trying to cash out some dough, or maybe refinance for a lower interest rate, or whatever you might do there. Okay. Anyway, this is a personal loan, had a fixed interest rate for 5-year term, monthly payments, IO, and at the end, they own the full amount. And that is called a straight mortgage. Okay. Hey, you need to learn the definitions of all these words, guys. So don't walk in an exam if you haven't spent a lot of time working on the terms. Okay. Next question, please. Okay. R wants to buy Q's home, but being new on the job, he couldn't qualify. Lenders like you to be, in the same job for, a couple of years minimum. We'll expand that in just a minute. Q agrees that with $15,000 down, Q would carry a loan for the remainder of the purchase price, amortized over 30 years at 8%. And this is what kind of loan? Well, it's a wraparound. Okay. Why is it a wrap? Because we're assuming that there is an existing loan on the property. So he wants to buy the home, and it's Q's home. Q's the seller. Okay. But being new in a job, it couldn't qualify. So Q, the seller, agreed that with 15 grand down, he would carry the loan for the remainder of the purchase price, all of it, whatever it is, amortized over 30 years at 8%. And he wrapped the underlying loan. Okay. That's a wraparound. We're not seeing people do a lot of this right now, but we might, particularly on some of the mid to high range type homes. Blanket mortgage is a loan that covers, like a blanket does on a cold night. It can cover more than one person, hopefully, but a blanket loan is a loan that covers both real and personal property. Sometimes you see this when you're selling a business, and they're buying the building, and they're buying the business, and they're buying the equipment for the business. Usually it is real and personal property that you're buying. Double contract is something illegal. It's real nasty. This is going to get you in big, big trouble. You're going to lose your license for this. And if it's a federal loan, you might even serve some quality time at at the government expense because you're going to get arrested and get some jail time. But a double contract is where you have two contracts. That's why it's called double contract, two contracts. One that's the real deal where you're buying it for $500,000. And the second one is the false deal where you're saying you're buying it for 650 grand and you're asking for a $500,000 loan. So in essence, what you're doing is you're trying to trick the lender, you're trying to defraud the lender into lending you more money than they ordinarily would, based on what they consider as standard or good business practices. You're lying to them. You're saying, well, I'm really paying 650 for this property. I only want to borrow 500, and you trump up a down payment. You do all kinds of funny things to make, that con men do. But double contracts is illegal. You don't ever get involved with those. In fact, if you ever get into a situation where you're feeling a little uncomfortable, you get with your broker, you get with the senior associate in the office who's been around, and you say, hey, I'm getting in this deal, and the buyer and the seller were talking like this, or the buyer's talking like this and that. I don't know. I'm uncomfortable. Is that standard practice? Is that okay? And they'll say, no, it's loan fraud. So don't do that one. No one deal is worth losing your license and getting incarcerated. A discount loan or note, a discounted loan or note is just sometimes the lender wants to raise cash, and they have a loan that maybe is 200 grand, but they'll sell it to you for 150. The borrower still owes the 200 grand plus whatever interest rate they agreed to. They're not going to go back to the borrower and say, hey, we're going to discount your loan. Do you want to pay it off for a little less? They just don't do that. They generally sell them to somebody else, and you can buy it at a discount. A discounted loan or note. Okay. Cool terms, huh? You just got to know what they are, but it's cool terms. Next one, please. Okay, here's a seller that has trouble selling their property because they have a due on sale clause on their mortgage. Now, a due on sale clause is a clause in the mortgage document, or what we call the trust deed, primarily here in Utah, that says that if they sell a property to anyone else, they have to pay the lender off. So that means due on sale. I mean, the loan is due on sale of property to someone else. Now, there are exceptions to that. In a divorce, one person, wants to get off the loan, and they make a deal with the lender to release them or something. Well, that a sale? Yeah, kind of. If or a situation where they sell it to someone else and let them take over. Here's the payment book. Make these. They're going to pull those loans. See, here's the deal. Lenders want to make money. Hello. And so what happens is, in the last few years, we've seen incredibly historic low interest rates, 3%, 2%, 2.5%, 3.5%. So the lenders have made a lot of low interest loans. I mean, crazy loans. And so what could happen is the interest rates might jump up to 6. So being a lender, let me see, I'd rather keep my money out at 3 or lend it out at 6. What do you think they're going to say? I want the 6 if I can get the 6. So in some markets where you have this differentiation and you've been an increase in prices, they even hire skip tracers and private detectives to come in and research all their borrowers to make sure they haven't sold that house and someone else is making the payment. Yeah, normally that's not going to take a lot of sleuthing, because what happens is the new owner generally gets a different insurance policy. So here's a lender, and they get a policy from the insurance company that says, oh, the house on Maplewood was bought by the Smiths, but there's someone named the Jones that's insuring the home now. They're going to figure it got sold. They're going to exercise their due on sale clause, and it's going to be a mess. Because they're going to foreclose, or tell that buyer to refinance or something, and they may not be able to afford the house at twice the interest rate. I don't know. Anyway, the sellers have trouble selling your home because they have a due on sale clause in their mortgage. They don't want to have to, pay off the balance. They found a buyer that's willing to assume the mortgage. They draft 2 contracts, one to sell the property and the other to show the lender so they don't know the property's been sold. They invite the agent to be the transaction broker of their sale. What should the agent do? Run out and get some errors and omissions insurance. Errors and omissions insurance is something that's really good for your broker to have, for the broker you go to work for, because if somebody makes a goof or an error, you're covered. But errors and omissions insurance doesn't cover loan fraud. It doesn't cover fraud of any kind. If you're a bandito, you're not going to be covered by errors and omissions insurance. You're going to be found out. You're going to be thoroughly embarrassed because you're going to get your license revoked. It's going to be on the internet. People will search your name. It'll pop up. Your license was, taken away from you because, you're a criminal. And if it's a federal loan, you're going to be in really big trouble. All right. Choose either the buyer or the seller to represent, not both. Well, you can represent both people, but hide the transaction from their broker. No, can't do that. Advise the seller and the buyer that a double contract is legal. Gosh, this is not a hard question, okay? I think we're going to go with D on this one all day long, okay? You don't hide things from your broker. Your broker needs to know what you're doing all the time. That can save you a lot of grief. In fact, the cool thing is many times they know of a way of putting a deal together that's perfectly legit and okay, but you don't know because you haven't done, thousands of deals yet, okay? Choose either buyer or seller to represent. You can represent both people in a transaction. That's not the issue here. The issue here is you're cheating. So don't do that. Okay? No one deal is worth your career. Okay, it's just bottom line. This is a great business. I mean, you can make serious money. I don't know if you guys have done a little math, but if you're getting discouraged, sit down with a blank piece of paper and a pen and a calculator and say, let me see, if I sold a $400,000 house and there's going to be 2 agents in the deal, I'll represent the seller and someone else will represent the buyer. So I get 3%. My broker's going to put me on a 60-40 or 70-30 split or something. Ooh, that's a lot of money. Half a dozen of those in a month, and man, I'd be in really good shape. Even 12 a year would put you in good shape. But, if you do 20, 30 deals, you're going to be in great shape. My first year, I did 54 transactions. My second year, I did 98. Okay. There's nothing special about me. I just worked real hard, and you can too. All right, next question, please. I was hungry, had a fire in my belly. Didn't like driving around a Volkswagen Bug. Okay. What kind of title insurance would provide the most protection for the buyer of the property? Title insurance now. Title insurance is insurance that the seller buys and gives to the buyer to ensure to them that they're getting good title. Okay. And it's also a policy that the borrower, the buyer, who's also a borrower, most people don't pay cash, so they get a loan. The borrower buys a policy for their lender because the lender, has more money in this deal than the buyer does. The buyer had 100 grand down. Lender has $400,000 in this deal. Do you think the lender wants to make sure that if there's a title issue that they're covered? Sure they do. Okay, so what we're looking at here is there's different kinds of policies. Now, and going over this, so the correct answer is A, the extended owner's policy. Okay, also sometimes called the homeowner's policy. Our real estate purchase contracts that we use that, were approved by the real estate division in the Attorney General's office. It's a standard form we use in all our residential transactions. That form calls for what they call the homeowner's policy, which is an extended owner's policy. So it's the best policy that can be given. It's not the cheapo, it's the El Primo Deluxe policy, okay? Now, plain language policy is also a great policy, but we don't see that term used that much in Utah at all. We call it extended, or primarily we call it the homeowners. ALTA lender's policy and ALTA policy, they're all ALTA policies because ALTA stands for not the ski area we have here in Utah, just 10 miles from my house, but it's the ALTA is the American Land Title Association. American Land Title Association. And what they've done is nationally, they come out with the standard that says, okay, if you're going to do a extended owner's policy, this is the verbiage and things that must be included in it. And so, real estate is sold a lot across state lines. We have a lot of people that own property in Utah, don't live here, or they live in Utah, but they own a lot of properties, and so they want to make sure that, the policy they're getting in California, well, I'm familiar with an ALTA policy, well, that this meets ALTA standards. And standard policy is kind of like the cheapo policies, and, we don't use them that much here. And we don't use them. Why? Well, because our contract calls for the El Primo Deluxe homeowners policy, also called the extended owner's policy, okay? So different kinds of insurance, but if don't confuse this with private or private mortgage insurance, because you had a small down payment. Okay, that's not what we're talking about here. That does cover the lender in the event of a default, but it could be that there was no default. Everyone was paying their payments, but there was a title issue. Someone came and said, well, the guy you bought it from was probably an okay guy, but the guy he bought it from was supposed to be my grandfather, but it wasn't. It was his evil twin that sold the property to that guy, and he forged his brother's signature on the deed, and stole his brother's driver's license. Or identical twins. They can, whatever soap opera you want to look at. But the point is, there was a challenge on that title, and so that's what title insurance do. It will ensure to the lender that they're going to be okay, and it will also ensure that the other policy will ensure to the buyer that they're going to be okay. So the title insurance company, just like if you totaled your car, will write you a check for what you paid for the house. Now, let me see. If you bought that house 5 years ago, you paid $500 for it, but now it's worth $895. Do you want them to defend the title, or do you want them to write you a check for $500,000? No, you want them to defend the title. So they'll fight it in court, and there's a lot of ways that they can win. But the best is a concept called adverse possession, which is beyond what we're talking about tonight. But adverse possession, Utah, only takes 7 years, and you can use tacking. So if the seller you bought it from has only been there 3 years, but the person they bought it from has been there 5 years, that's 5 and 3 is 8. And so, the title insurance company doesn't want to pay out $500,000. They want to have their lawyer go down and fight it in court and win for you. It's going to be a pretty easy case too if it's beyond 7 years. Okay, you just have to meet the adverse possession rules. A lot of people think, well, adverse possession, gosh, that's when you find a vacant home and you move into it. You pay the taxes for 7 years and then shares. Cool. No, that could happen, but probably not very often. So what it really does is it cancels out all title deed defects. And then we have another law that cancels them out after 21 years too. Okay, but anyway, next question, please. A purchase offer for a property is signed, and after a title search, it's revealed that there are 2 liens outstanding on the policy, which is true. 2 liens outstanding on a policy. Okay. Now, what could they be? Well, recently I did a closing about, I don't know, 14, 16 days ago, something like that. And when I put a property on a market, I want to know what condition the title is in. So I immediately order a title insurance commitment. And on that title insurance commitment, I saw that there were 2 outstanding mortgages on this property. Well, people have a first and a second sometimes. But in talking with the seller, he told me he only had 1 loan on the property. So what had happened was they had refinanced the property about 12 years ago, and that should have paid off the first mortgage loan. Well, it was probably paid off, but there's something called a deed of reconveyance that needed to be published in the public record in order to prove that that loan had been paid off. And that was the case here. It only took about 2 weeks to straighten that problem out. But order your commitments early. Be smart enough to read through it, and you can have your broker or senior agent or call me. Well, I'll show you how to do it. But you go through that title insurance policy, and it'll have things that are requirements, and then that'll say, okay, a payoff for this loan, a payoff for this loan. In this case, there were 2 liens. Could have been an old mortgage. Could have been a mechanic's lien. Could have been a lot of things. Could have been a tax lien. Could have been a recovery services lien. A lot of things that could have popped onto that property. And could have been, well, I mentioned the judgment. Well, anyway, the point is, which is true? Well, the buyer wants to buy the property and the seller wants to sell it, but you've got to pass marketable good title. So who do you think is going to be responsible to satisfy those liens? Obviously, the seller. And in today's market where prices have gone up a lot, there's probably enough equity in that property, even if they didn't have a lot of equity to begin with. If they bought it 10 years ago, it might be worth double what they paid for it. So the seller's got to pay those off, and the title company will find those, and they'll contact those people that are owed money, and they'll come to some sort of a payoff amount. And that'll be in the settlement documents at the closing, where they'll take the money from the buyer, they'll pay off all those liens, taxes, other bills that might be due, and then they will give the seller the difference. Okay. The buyer and seller will equally share this responsibility. Does that sound fair to you? No, not. The buyer has nothing to do with these old loans. Existing liens are eliminated when a property sells. No. That's why we do title searches and make sure that you're getting good title. And the buyer is solely responsible to satisfy those liens. No. Nope. Seller's responsibility. But order those commitments up front so that if there are problems. Another one I got closing in about hopefully 10 days. There was a border boundary issue, and there was a boundary agreement signed. So I got a copy of that. The commitment will list things that are on that title, okay, but it doesn't necessarily have the boundary issue document. So I called the title company and said, I want a copy of that. And I got it, and I read it, and I understood it, but I got it because I thought if the buyer called and said, well, wait a minute, what's this boundary thing all about? Well, or the other agent was representing the buyer, I could explain it to them and give them a copy of it. So the commitment went out, the buyer had it, they were able to examine the commitment, and hopefully their agent, spent a couple of minutes with them and showed them through that. I suspect they didn't, but nevertheless, they were warned that there was that boundary issue, but I guess they weren't concerned about it. I never heard, and the title company never heard from them. So, their due diligence deadline is passed, so I'm not really going to worry about it. I am going to put a copy of it in the file if anybody ever wants to read it, but It was only like 6 or 8 inches, and they just agreed to, to leave the fences where they were. So it wasn't a big deal anyway. It's at 0.58 acres. It's, plenty of land there to mess with. Okay, the purchase offer property, sign out the title of 2 liens, and of course the answer is, guess what? A. Seller's responsible for those suckers. Okay, next question, please. On the settlement statement for a property closing on March 16th of the year, the proration of property taxes would appear as. Now, property taxes are always paid in arrears. We're always paying for the year that was, okay? So the seller has lived in this house through the closing on March 16th. So he was there January, February, and March, or at least half of March. And those taxes that are due for those 2.5 months or 3.5, to 2.5 months, or let's see, January, February, 3.5 months, they won't be paid till next December or so, or next November, depending on when they want to pay it, November or December. The bill comes out in December. Usually, needs to be paid before the end of the year anyway. So how are we going to do that? Well, we're going to prorate it. There are a lot of things that get prorated. If you are assuming a loan with the lender's permission, you're going to prorate a monthly payment. If you are, if there's a tax amount, if there is some sort of a, lien against the property, that was for, that is going to be assumed by the buyer, like a lien for improvement that was done, a special assessment or something. Sometimes buyers will take those over. Well, then we're going to prorate that too, depending on what's paid. We also prorate HOA fees. Usually they're paid in advance, but whatever. So here's the deal: a debit is a charge, and a credit is a credit. You know what a debit card is. You know what a credit card is. Okay. So on this deal, the seller is going to be debited, right? Why? Because we have to collect money from that seller for the first 2.5 months. You with me? So credit the seller, C and D, they can't be right. We have to charge the seller for the taxes that are going to be paid by the buyer next November, the end of the year. Okay? So what happens here is we do what's called a proration. We debit the seller and we credit the buyer. We give the buyer the money from the seller. And then what happens is the seller then walks away, and the buyer at the end of the year pays the whole tax amount because he was given the seller's share of the taxes when he closed on the property. So we're going to debit the seller and credit the buyer. Okay? You have to have a good feel for debits and credits. You're not going to have to calculate anything primarily. There could be one math problem, but I doubt it. The student that took the test Friday said she only saw 6 math problems. So usually it's 6 to 8, somewhere in there. And she says they were all pretty easy, but she's a math savant, so of course she'd say that. Okay, let's look at the next question, please. We've got a couple more questions, and then does anyone have any other questions up to this point? I'm doing a lot of talking. Okay, yeah, it was your chance. All right, let's look at the next question. So we have some time left at the end here. Ooh, we're really pushing it. Okay, in order to obtain underwriting approval for a federal, you got that question, Dan?
Working on it.
Okay. Market's great, folks. It's a little weird, but that's okay. The market's always a little weird. It's always, I got no buyers, or in this case, I have more buyers than I can find homes for. Hey, look, it's always a seller's market or a buyer's market. It's never an exactly even market. The exact number of homes went on the market and the exact number of buyers showed up to buy them. And everything was perfect. It's only because of the fact that the buyers are rabid to get something to live in, and they need us desperately, okay? Or there are no buyers and tons of sellers. So these sellers need us desperately. If it was one of these even markets, you know, they wouldn't need us so much. Okay. Did you find it, Dan?
That was the last one in the presentation I had.
Oh, okay. All right. That's fine. Okay. Because we're running out of time anyway. Okay, guys, do you have any other questions that we can help you with? Come on. You got to be something you're stuck on or worried about or interested in, or any topic, doesn't matter.
Where's the best place to go to review the vocabulary?
Well, Dan, what have we got?
There is a glossary right on the school website under resources.
Okay.
But Rick, don't you have a Quizlet that does a vocab review, or is that different than what you've got?
Yes, I have a Quizlet. You could go to rickroller.com, and at rickroller.com there is a Quizlet program. You can download it. It's free. I don't charge for it. And you have to have a password. The password is limitless agent. And that has a lot of different things. You know, that's my website address. Anyway, you can go there. You can download it free. The password you need is limitless agent. And that'll let you in the program, and you can do lots of different things. You can play hangman, you can do other things. I would suggest you only use the flashcards. And the flashcards can go from definition to word or word to definition. You can, use them both, okay? Back and forth, however you want to do that. There's also a little button you can push where it will talk to you. So it like I'm reading these questions tonight, it'll read them to you, if that works better for you. But it's really helpful. It has, there's about 400 plus terms you need to know, and I've got all the ones you're going to see on the exam on there with easy to understand definitions. And it's something I put together to help students, and I hope you take advantage of it, because knowing the words is really, really critical, getting through the test. Okay, it's free. Also on there, there's several videos. There's one on how to choose your first broker. You only got one chance. You have to choose the first one anyway. There's things you might want to think about when you're out interviewing. There's also there's one on there, things you can do while you're in real estate school to hit the bricks running, so that you're ready to hit the business immediately when you get that license in your hand. You cannot solicit business without a license, period. And don't push that. If you feel like, well, I don't know, could I do this? Call me. We'll talk about it. But you can tell, like your Facebook friends and family and whatnot, what you're doing with your life. You can say, hey, I'm in real estate school, and here's what we learned today. I learned about different kinds of loans, and there's participation loan, and there's this kind of loan, there's that kind of loan, and what's real popular right now is this kind of loan. And, boy, I'm all excited to learn all this stuff about real estate. And then shut up. Don't say anything. And when I get a license, I want you to use me, because that is against the law. So don't get in trouble, but you can tell people what you're doing. So she sent out a notice Monday to all her Facebook people that, hey, look, I passed my real estate exam. A lot of you knew that I was taking a test. Just wanted you guys to know I aced the dang thing. I passed it. Boy, am I excited. Okay. So in other news, last night we had hamburgers, whatever you do on Facebook, okay? But don't say, and when I get a license, I want you to do business with me. Now, I know that's really on the edge, and if you feel like that's too much, then don't do it. But you can talk about things. Well, hey, I learned in real estate school today, there's like 3 ways in Utah that you can actually own property with another person. You could be a joint tenant, you could be tenancy by entirety, or you can actually be what's called a tenant in common. Here are the differences and how they work. Man, I love learning about real estate. That's all you say. That's all you say. Okay. Okay.
We do have that key points document that we linked just a little earlier, and that's not strictly vocabulary, but it's a document where we took both textbooks, the national law and the Utah law, and we condensed them down into about 15 or 20 pages.
It's what I would call a practical vocabulary, because it gives you scenarios that is using that vocabulary word, which is really, really good too. I mean, I really like the effort that Dan has put in to put that key concepts or key points review out for you guys. And there's no cost for it, guys. Just get it. It's part of what you paid for. And Dan's not going to tell you this, but I will. You know, a few months ago, the real estate division called and congratulated Dan because he had 100% of the students from his school pass the exam. And this month he had a call already from the division saying, Dan, I don't know what you're doing over there, but my gosh, it's really working because you had the highest pass rate of any school in the state of Utah. There wasn't anyone even close to you. Your nearest competitor was 20 percentage points below you in passing rate. So kudos to Dan and what he's doing with the school. Folks, you're in the right place. You'll be well prepared, but it's going to take effort on your behalf. And it's going to take the right kind of mindset, you know, not only to get through the exam, but to be successful in the business as well. So another thing that, you know, you can get at the rickroller.com website is you can get a digital copy of my best-selling book called Limitless. And this is a book that's all about mindset. I mean, you can get a digital and an audio copy if you like to, you know, if you like to hear books, you know, as you're driving or audio, or you can just get it and read it on your iPad or your Kindle or whatever. And what this book is all about is that, you know, years ago, you probably maybe heard about the movie, The Law of Attraction. In fact, it was just done as a remake. Where they made it more of a drama. The law of attraction is one of the conscious creation principles, but there's more than just the law of attraction. There's 9 of these. So it goes through the 9 principles of conscious creation. Real estate is a mind game, more than anything. You've got to get your head straight as you go out there to make this business work for you. You've got to believe in yourself, believe in your brokerage, believe in what you're doing, and there's a lot of ways that you can create the things that come into your life through these 9 laws of conscious creation. So it goes into those in details and gives you little exercises on how to do better with those. Then it goes into a word-based procedure called breakthrough on how to get rid of your negative self-talk and your limiting beliefs. And in the back of the book, we spent a lot of time putting this together, but in the back of the book, there are over 1,000 different limiting beliefs. And then the turnaround belief that is what you should have. Like, you know, I'm a loser. Well, you know, that's pretty bad. I mean, but no, I'm not, you know, I work hard and I'm worth the money. And, you know, I mean, it's really good. And so what you do is we put in like 4 categories, wealth, health, connection, and then what happens is you I suggest you take, you know, the digital copy of the book and you go through these and mark the ones that are your problem for each category, and then take that category and take the worst one and work on that with the breakthrough process, and you'll be in a much better situation to take the bumps as they come along in our business. Okay. It is a fabulous time to get into real estate. You know, a lot of agents saying, well, no, God, I hate everything right now because I got this buyer and I'm trying to get him a house, and you know, we've made offers on 5 different homes and we didn't even get one of them, you know, because of all these multiple offers that are out there. Well, you've got to learn how to make your offers really attractive. This one on this property I have closing in a few days. See, that was $565. You know, we had it listed for $550. You know, sold for, you know, 15 grand over the list price. Okay, so, but one of the things that they did to make his offer, you know, we had 3 offers only. And the house is a wreck, but we still had 3 offers on it. And the first offer was kind of a standard offer, wasn't all that exciting. The second offer is $15,000 earnest money. And when the seller signed accepting the contract, 2,500 of that 15 was the seller's, no matter what happened. So if the buyer can't get the loan, doesn't want the house because of the condition, inspection didn't come out, whatever reason they walk away, the seller keeps $2,500. And at the end of the buyer's due diligence period, he gets another $2,500 non-refundable. Well, that makes the offer, so the seller says, man, these people really like the house. They're probably not going to back away. And, if they do, I make $5,000. I like this offer. That was very competitive on how they put it together. Short closing times are good. We had one of the offers, they waived the appraisal contingency, which means regardless of whatever appraises for, they're still going to buy the property. So if the appraisal came in low, like a lot of them are right now, then they have to pay over the appraisal. So you need to learn as the market changes, and we go through a seller market, a buyer's market, we get into foreclosures with short sales, all these other things. You have to change with it. You have to learn how to survive in the market that you're in. And for that agent who was very discouraged, and they called me and said, Rick, help me out. I'm so discouraged. I said, you made offers on 5 homes already, right? And you didn't get any of them, right? Right. Okay, learn how to make your offers more competitive. And we talked about some things like I just did with you. And then I said, now I want you to realize something else. Well, what's that, Rick? In every one of those 5 situations, there was a winner. And what was the common denominator? There's always a winner. And what was it? It wasn't you. You didn't get any of your offers accepted. It was the listing agent. The listing agent on all 5 of those transactions got a deal. So I don't care if it was 14 offers at over $1.5 million and Harvard Yale area downtown, or if it were these 5 properties wherever they were that this agent was trying to get for their buyer. In every one of those situations, who was always the winner? The listing agent. So in a market like this, would it be better to have 5 buyers or 5 listings? I'll let you come up with the answer to that. With things selling so quickly right now, you'll probably have 5 listings under contract within 5 weeks, maybe less. But those 5 buyers you're working with are driving you crazy, and you're making a lot of multiple offers. Now, in a market like this, I would suggest, to retain your sanity, that you only work with buyers that you have a relationship with. In other words, you sold their house out from under them, and now they need a new house. Okay? You've already proved performance with them once. Only work with buyers that have sufficient cash that if the appraisal comes in low, they can pay the difference on the top. Okay? Not that they're scraping up barely enough money to get into a home. A buyer like that, their chances of you getting a home that'll work for them is very slim. And another thing that works real well in a market like this is find out and focus on taking the buyer to new homes as well. New homes, new condos, whatever, because sometimes they're easier to get, okay? Because what they're doing is they're only opening up like 8 new homes in the next 2 weeks. And that's all when those are sold, we're not going to sell any more homes. And then when we get down the road, we'll open up 8 new homes. Well, if you're familiar with the agents that are working for that home builder, and when you're going to throw those on the market, to get there a day early or 7 a.m. the day of, and you've already kind of had a heads up on which lots, and they've looked at, okay, I want the snow castle model on lot 15, and then you just throw them in. Now it's going to take a while to build that new home, but at least you've got it under contract, and they know that they have something there. And so a lot of agents don't take advantage of new homes. I've always sold a lot of new homes. It's great. I mean, new homes are expensive, $500,000 to $700,000. Condos, my gosh, you can't even get a condo for, $385,000 to $425,000, or townhouse. So it's a great time to be in the business, but you got to know the strategies to make it work. Well, we thank you for being here tonight. Please take us up on our offers. Please get that key point. Dan, why don't you throw that up again? Make sure they got it, that link. but that is so powerful. It's kind of like a crib sheet. You know, if you want to spend quality time with something the night before your exam, work with those sheets. You know, there's a lot of them, but you know, you can get through them. And you should be the point where you're doing that on that key point summary. It you know, it should make a lot of sense to you. You should be able to explain it to someone so they would understand it. You are preparing for a multiple choice test. You don't have to conjure up the answer, or, you know, what are the three things about this? Blank, blank, blank. You know, that's the whole different kind of test. This is a multiple choice test. The answer will be right in front of you. You don't have to know the right answer as much as you have to recognize it. You can do this. And you can especially do this at our school because we've worked real hard to give you the information that you need to pass the test. Thank you for being with us tonight. Every other Tuesday, come join us. And in the interim, Dan's available, I'm available. Give us a call. You know, don't be a stranger. If you need some extra help or extra time, or you're just afraid, or someone told you you're a stupid idiot for trying to get into real estate and you're losing confidence, talk to us. I was flat broke when I got into real estate, but I bought my first house 3 months after getting into business. 2 months later, I bought another fabulous home in the ritzy area. I mean, don't believe all this nonsense about you can't do this, you can't do that. You can do whatever you put your mind to. You can get a copy of my book. It'll help. Thanks, Dan.
Thanks, guys.
Thanks, Larry. Thanks you, Rick, very much.
Thank you.
Thank you.
Glad you guys were here. We'll see you in 2 weeks.